Hello, everyone. Thank you so much for joining us this evening. We're so glad to have you joining us at this episode of Money Matters, where we are going to be talking to you about everything related to credit scores. We'll give everyone some time to get logged into this Zoom link. While we do, I'm going to go over some general housekeeping tips just to make sure that we all are on the same page and have a smooth session together. While we wait, what I'm going to ask you to do is to make sure that your Zoom profile shows both your first and last name, as well as your pronouns if you wish. This will help us get to know you a little bit better throughout this event, but also will help us make sure that the proper person gets attendance credit for being here tonight. So if you're not quite sure how to check or rename your Zoom profile as needed, there's a couple different ways that you can do so. One is by looking down at the bottom of your toolbar here in Zoom, and you should see a tab that says Participants. And if not, look for a tab that says More. Click on either of those buttons, and then you should see a pop-up window appear with your name at the top of that list. Hover your mouse over it, and then 3 little dots should appear that allow you to check and rename your Zoom profile accordingly. Another way to accomplish the same task is by looking up at the top of the screen where you see all the different Zoom tiles for today. And even if your webcam is not yet turned on, yours should still be at the front of that row. And when you hover your mouse over it in the top right corner, you should see 3 little dots that, again, when clicked, will allow you to rename that profile as needed. So again, please make sure that at the very least, it shows both your first and last name so we can track proper attendance throughout this event. Also, please know that this event will be recorded for educational and promotional purposes so that we can share that out later on our YouTube page with closed captions so that students who weren't able to join us live can still watch and learn from the content, but also so that you can watch it in replay to refresh yourself in everything that we have to teach you tonight. If you don't want to be part of that recording, that is absolutely okay. You are welcome to leave your camera off, and there will still be ways for you to participate and engage and ask questions throughout the evening. As I just mentioned, closed captions will be available and provided throughout tonight's activities. And so if those would help you out with learning and being able to follow along, please go to your Zoom toolbar and click the button that allows you to show subtitles or enable captions. And if you don't see a button specifically for that, again, look under the tab that says More. Now, we want to make sure that this event is something that everyone can easily follow along and hear as able. So we do ask everyone to please keep your microphones muted, and that way we can all be able to easily hear and understand the speaker. However, in addition to wanting this to be a fun event, we want to make sure that it's also a time where you can get your questions answered. So at any point throughout this event, please make sure that you ask us questions, and you can do so through the chat feature here in Zoom, which again, you can find through that Zoom toolbar. We'll be communicating with you and sharing links in that chat feature as well, so get comfortable and used to using it. We also want to make sure that this is a safe space. And so we do ask everyone to please make sure to keep all conversation respectful, civil, and clean. Bottom line, just be kind and we'll all have a great time. Also, at the end of this event, we will be sharing you a link to our feedback survey. And it's really important that you make sure to get that done by the end of this event. The reason why is because that's what lets us know you have finished this event and you are ready for OneAZ Credit Union to send you a certificate of completion. Also, completing that feedback survey is going to be what enters you in our tuition award drawing. So if you attended both of our Money Matters events this semester and you completed that feedback survey for both of those events, that's what gets you entered in that prize drawing. More details on that later. Speaking of prizes, in addition to that tuition award drawing, there's going to be some other real-time instant gratification prizes that you will have a chance to win throughout tonight's Money Matters. So if you follow us on our social media pages, that will be what enters you in a prize drawing for a bundle of donated items from Pima Community College and OneAZ Credit Union. We will be selecting 2 winners and announcing them at the end of this event. And the way that you can get entered in that prize drawing is by following the social media accounts that you see listed on the screen. So to connect with the First Year Experience program on Instagram and X, look for the handle Pima FYE. And to connect with the Office of Financial Aid and Scholarships through Instagram, look for the handle pima.financialaid.scholarships. And again, by the end of this event, we will announce 2 winners just for having followed us on those accounts. And as I mentioned, you will also have an opportunity to be entered in our tuition award drawing. It's going to be worth $300 and applicable towards the next semester here at Pima Community College. So more details on that later, but bottom line, make sure that you follow us on our social media and you complete that feedback survey at the end of this event. Now, it takes a wonderful planning team to get tonight's event prepared and coordinated for you all to enjoy. So we want to take a moment to introduce ourselves in case we have not yet met. I am Renee Forsyth. My pronouns are she, her, and hers, and I lead the First Year Experience program here at Pima Community College. Our entire mission is to connect new students with people and programs that will help them be successful in their journey at college. And that includes connecting them with financial literacy resources, such as the awesome folks who I have partnered with and work with for this event. So let's go ahead and have them introduce themselves.
Thank you, Renee. And hi, everyone. My name is Carla Gonzalez. My pronouns are she, her, and hers. And I am part of the Office of Financial Aid and Scholarship team as the Assistant Director of Scholarships and Outreach. I also like to introduce one of our colleagues who could not join us today, but also is part of the reason why we're able to host these sessions for you. Her name is Juanita Bonillas, and she is a manager of our Second Chance Pal program and scholarships and outreach. And without further ado, I'll pass the mic on to Anna.
Good evening, everyone. My name is Anna Brown. I am the Scholarship Operations Coordinator here at Pima Community College. I'm excited for this session to learn with you all. Simara?
Good evening, everyone. My name is Simara. My pronouns are she, her, and hers. And I am the Outreach Coordinator for the Office of Financial Aid and Scholarships at Pima Community College. It's a pleasure to be here with all of you today. Thank you for coming. I will now let our partners from OneAZ Credit Union introduce themselves.
Thank you. Good evening, everybody, and thank you for your time in advance. My name is Vanessa Alfaro. I'm the Southern Region Sales Leader for OneAZ Credit Union, and my pronouns are she, her, and hers, and I do have a partner in crime that I'm going to let introduce himself.
Thank you, Vanessa. Hello, everybody. My name is Michael Moreno. My pronouns are he, him, and his. I'm a personal banker in the Southern region for Vanessa. So I've been working with her for 3 years now, and we look forward to being able to present this to you guys.
Thank you. So tonight's featured topic is going to be understanding your credit reports and scores. This is a really important topic that I think we all could benefit from learning more about. And so I am going to hand the mic over to our partners from OneAZ Credit Union so they can tell us more.
Thank you, Renee. Yes, again, thank you for your time. Our time is valuable, and I hope that you gain a lot of knowledge and we answer a lot of questions as we go through this presentation this evening. This is a fun one. I feel like no matter what stage you're in or where you're at in your credit journey, we always get something or learn something from this presentation. So buckle up. There's a lot of info to go over. I'm going to touch on the agenda here on the next slide. And we will have questions and answers towards the end, along with that fun activity that was mentioned earlier. So we'll just jump right in and cover some of the things that we will be going over. So we have 8 8 topics this evening built into this presentation. So we're going to go over why credit is important, what's on our credit report, obtaining your credit report, information on identity theft and credit, how scores are calculated, how to build your credit, common myths around credit, and tips for using credit cards wisely. So a lot of information is going to be jam-packed into the next 40 minutes or so. So please, write those questions down, put them in the chat, and we will get to them towards the end of the presentation. But hopefully I go over a lot of what you have on your mind as we go through some of the material. So we'll just jump in here. All right. Okay, so why is credit important? We're going to go over a few reasons why credit's important. We know we have the obvious one, that is lending, but this is one that we don't always think of right away. It could deter you from landing your dream job, or help you get your dream job. So most of us don't realize that 38% of employers actually do credit checks before extending an official offer. That's a big part of our job force out there, industries. And the reason might be for security clearance. So not all reasons are the same. Not all industries are the same, but some security clearances might require a credit check, background checks, or if you're working for a financial institution, that's another one, another example of landing your dream job with a bank or financial institution. We may run credit just because we want to know that if we're being hired to give that good advice, that we also have that experience and that knowledge, and can give you the best advice and steer you in the right direction as possible. So it does not mean that credit or having less favorable credit or poor credit is going to deter you completely, or keep you completely from getting the next job. But that employer might ask you to maybe work on a couple things, or maybe provide a letter of explanation, or maybe the role that you're applying for specifically may not be available to you based on your credit history, but maybe they have something else within that organization that you could potentially qualify for just based on that that credit pool and what those requirements are for that job. So again, 38% of employers on average will pull credit. That's not the obvious one that we always think of when we think of why credit's important. So I do like to mention that. The next one is going to be one that we all eventually need one day or are already experiencing, and that would be renting or owning your own place. So whether you're renting or buying, credit's going to be important. It could end up costing you more money. Doesn't mean, again, if you have poor credit, bad credit, less favorable credit, or maybe not enough credit, somebody that maybe your landlord or a property management company, they might just ask you for additional deposits. So maybe your first and last month's rent, maybe you need an additional security deposit. So it's important to understand your credit and know where your credit is at when you're planning to rent another place or rent your first place, and even when buying your own home, because you're going to start rate shopping. And those credit scores are important to know and understand before you commit to something as big as owning your first home or purchasing another home. And for that most obvious reason, any loan. So understanding your credit, why it's important. This is the story that you are telling the lender. So your credit report and your score is your whole credit history, your whole credit journey. We understand that things happen. We can get explanations for that, but really your credit report is your story to the lender to determine how much of a risk you are when applying for that new debt, because we're letting you borrow our money in good faith. And so we want to make sure that you have been responsible. And again, if you don't have enough credit history built, we'll go into that a little bit later, but that can also impact if a lender views you as credit worthy. If we don't know enough about you, it could make it a little bit harder to get that loan that you're looking for to reach those financial goals. So really, credit impacts every area of our life, where we live, what we drive, what job we get in order to pay for those loans. So it's really, really important that we understand how to maintain that good score. So in this example, I mentioned a few minutes ago or a few seconds ago that just because you have less than excellent or perfect credit doesn't mean that you don't qualify. You could absolutely qualify for a mortgage with less favorable score or a lower score, but it just might mean you're going to pay more in the long run. So I have an example here to go over where we have Angela and Diego. Now, Angela has excellent credit. Her credit score is 750. They're both applying for the same mortgage with the same term. Typically, you see a 30-year term when purchasing a home. And in this case, they're purchasing a home for $400,000. Now, because Angela has a 750 FICO, her interest rate is much lower than what Diego's interest rate is. And before I go any further, I do want to say that these are just examples. To get accurate rates, you would want to talk to a mortgage banker, but this is just similar to what we're seeing in the industry right now. So in this case, Angela's rate is 6.63. With Diego, he had a credit score of 660. His interest rate is much higher at a 7.51. There's about a $200 difference in their monthly payment due to the difference in FICO. So Angela's payment is $2,581, and Diego's paying about $200 more a month at $2,778. So to really put this into perspective, when you look at the life of the loan, the savings is $70,833. Now, I don't have $70,000, but I definitely know putting that into long term, that's not something I'd really even want to throw away, even if it's just over time. So if you're in the position to improve your credit before you buy that home, or if you absolutely have to buy that home now, just know that you might want to look at refinancing down the road to save yourself quite a bit of money. So in this case, Angela's higher FICO definitely helped her save over the long run, and also helped reduce her monthly payments, making her living expenses much more affordable. Okay, I get a lot of questions about this. What is on my credit report? How long might it stay on there? So we're going to go into some of the items that you might see on your credit report. First, I want to say that there are 3 credit bureaus out there: TransUnion, Experian, and Equifax. Your credit scores might be different. What's reporting on all 3 of these might be different, and I'll explain here as we go along. So on your credit report, you might see personal information: your legal name, previous names, addresses that you've lived at, maybe even your employer, all your credit accounts. So that includes your mortgage, your credit cards, loans that just personal loans that you've taken out, autos, any credit accounts that you have currently active and open. Collection accounts. So maybe you had credit accounts that you had something significant happen in your life. Maybe we missed payments. A collection account is when you let that credit account go delinquent to the point where it charged off, and now a third-party company is trying to resolve that balance that you still have outstanding and owed. So those collection accounts are not a good thing, but they do report on your credit until those balances have been collected or negotiated. Then you have your public records. So if there's any bankruptcies, any liens that have been placed, any public records that are detrimental to your credit are going to show up on there. So inquiries also, and these are hard inquiries, and we'll go more into inquiries as we look at what really impacts your score. But we're talking about hard inquiries when we're looking at what comes up on that credit report, and we'll go into more detail on that here in just a few minutes. What's not on your credit report? Information related to your income. So if you just got a raise, that's probably not going to be on there. That won't be on there. How much you make really won't be on there. Your savings account balances, your checking account balances, those things are not going to show up on your credit report. Your everyday checking account, banking accounts, those are not reported. Anything that you're really not making a payment on. Now, I will say, if for some reason you went negative in your checking account, that is when you might see a collection account or charge off show up on your credit report. So while you have that checking account active in good standing, it's not reporting to the credit bureaus. But if you do end up owing that bank money, it will show up as a negative collection account or charge off on that credit report. And your credit score is not a financial health score. So we're not looking at that when we're looking at the FICOs and the credit reports. Okay. We also look at positive credit staying on indefinitely. So if you have a credit card and you've had it for 20 years, your payment history, as long as it's all been in good standing, is going to stay on there indefinitely, as long as you have that account open and active. That's not going to go away. Now, if you have a credit card that you've had for 15 years, all those payments have been in good standing on time, but you decide that you no longer need that card, you're going to close it out today, that positive payment history could stay on your credit report for up to 10 years, that positive history. But if there's not any negative history, all accounts have been, that account has been paid on time, it will stay on there for as long as you have that account open and active. If you want to review what's on your credit report, there are a few tools and resources out there to help you. So if you go to annualcreditreport.com, you get one free full report per year. I strongly advise at minimum you check your credit report once a year, just to make sure that there are no errors, discrepancies, anything that could be alarming, any kind of fraud or anything like that. Make sure that you're checking that credit report, keeping your balances in line. And you can get that from, again, annualcreditreport.com once a year for free. There are also a lot of credit monitoring services out there that do not impact your credit if you're utilizing them. So you could check your credit every single day without it having an impact to your credit. But you're going to want to look at what's out there. I know, not being biased or anything, but we have an amazing credit monitoring tool that's built into one of our checking accounts. But they also have Experian has an app. There's LifeLock that has apps. There's a lot of different tools now out there, even some credit cards that have credit monitoring built into your apps. So check it out, check with your own financial institution. If you don't want to pull it through annualcreditreport.com, there are plenty of ways now and apps out there that you can review this information on a regular basis, again, without it impacting your credit. So let's say you pull up that credit report and you realize that there are some errors. So when you file a dispute, you're going to want to file a dispute with all agencies like TransUnion, Equifax, or Experian that may have that error being reported. Not all credit bureaus are the same. So if TransUnion has an error, Experian may not be reflecting that same error. So really look at all three to see where you need to start. But you're going to want to dispute with the creditor. So always try calling that creditor that maybe reported that an error first. So an example would be, let's just say your bank makes a mistake. Maybe you paid your loan payment, you came into the bank, you paid it, but they accidentally applied it to someone else's loan. That could potentially happen, but you'd want to contact your creditor so they can locate that error, and they would actually go ahead and update the credit bureaus to say that you did not miss that payment, it was not late, and it was a bank error. Then that could be removed. So you always want to try working with that collection agency or creditor first for any errors that need to be disputed or balances that need to be disputed. And then you're going to work with those credit bureaus. So TransUnion, Equifax, and Experian, they all have their own websites now. They make it pretty easy. You can actually go online and file a dispute. You can also do it through the mail. And then depending on what's on that credit, if it's fraud, we'll get into that next. But definitely make sure that you're taking the right steps to dispute any errors that you see. One of the errors that we've seen in the past is somebody with a similar name. So this actually happened to me a long time ago. I had a common last name, Gonzalez, and somebody didn't pay their cable bill. We had similar names. It showed up on my credit. I was able to dispute that and show that I've never lived at that address before. So definitely go through your credit. You'd be surprised what you see on there. There are things that you might potentially have to dispute. It's not out of the norm. That's why we encourage you to really check your credit at minimum once a year. But then we talk about identity theft. So there are a few more steps that you'll need to take if you feel like you were a victim of identity theft or fraud. So you'll want to definitely contact those credit bureaus. It could impact you negatively. So if someone's taking out loans in your name, has your social, they could take out credit against your credit report or your history. And if they go delinquent on those payments, it could actually impact your credit in a negative way. But this could involve also filing police reports. Now we have the ability to freeze credit. So if you feel like you've been a victim of identity theft or there's fraud on your credit bureau, you're going to want to work with all three credit bureau agencies to get your credit frozen. This can be unlocked at any time. If you do need to apply for a new loan, you can actually go on to their website and temporarily unlock. So this is just an extra level of protection when you've been a victim of identity theft. You're going to want to file those disputes. Again, place those freezes, and then you're also going to want to file a report with the FTC at identitytheft.gov. This is because we also want to flag your social security number. So if your social security number is used again down the line, this has been already flagged, and there's just that extra layer of protection. You're also going to end up filing a police report if accounts have been taken out in your name that were not you and were fraud. I've actually had to do that personally myself. Before I went and bought my home, I realized people were taking out loans in my name. It was actually pretty simple to dispute. It took maybe a total of 30 days for everything from start to finish, but I did have to file a police report. The nice thing is when you go to file a dispute on TransUnion, Equifax, or Experian, depending on the type of dispute that you select, it will tell you what next steps to take. So if you're unsure of what you need to provide as far as documentation goes, they will guide you on what you need to turn in order for them to start investigating and doing those and finalizing your disputes. You're also going to want to contact all your existing creditors and financial institutions. We see this a lot. Somebody says, my whole identity was stolen. They have my social, they have my checking account numbers, everything. So if you do feel like you were a victim of identity theft, you are going to want to contact all your existing creditors and financial institutions. So they can either open new accounts for you, reassign account numbers, or help you freeze any account that needs to be frozen until you sort everything out. Again, contact all 3 credit bureaus, contact those local authorities. And then what happens after? So if you are a victim of identity theft or you're seeing quite a few errors on your credit report, make sure you maintain good records and also check your credit report consistently following up just to make sure down the line there's nothing that pops up again. Once they have your social or any information that allowed them to obtain credit in your name in the first place, they can always do it again years down the road. So it's really, really important that you do that maintenance. Have one of those apps where you're checking it more than once a year and then maintaining, again, those good records, showing that you're paying those payments on time, where you live, any documentation that might help if you needed to file a dispute or a police report. Okay, this is the fun part, how credit scores are calculated. There really is no math that we can do to determine what exact score you're going to have tomorrow when you wake up, but I can help tell you how to positively impact your credit the most, and what can be the most detrimental to your credit score and FICO. So we all have a 3-digit number that is assigned to us based on our payment history or credit risk, and this helps determine the likelihood of repayment. And this is the most commonly used scoring model with lenders. So we're going to talk about how we determine and how this is calculated. What makes up most of the pie here? Well, we've all heard this, making sure we pay our payments on time. 35% of your credit score is determined on your payment history. Now, we talked earlier about those good payments staying on indefinitely as long as that account stays open. But if you close an account that had, or you have a missed payment, that could stay on your credit score up to 7 years. And that might even be one of the things that you look at that you maybe want to dispute. Maybe something that happened 7 years ago is still reflecting on your credit. That could be something that you dispute. But 35% of your score is based on your payment history and paying on time. I get questions on when does it actually qualify as a late pay? Now, your lender might have a 10, 15-day window grace period to allow you to be late. That doesn't mean that once you go past that 10 or 15-day grace period, they're going to report you to the credit bureaus. It's considered late on the credit bureaus once it hits 30 days. I don't advise anyone to push that envelope or make their payment 30 days late, because anytime you make a payment 1 day late, 10 days late, 30 days late, you're actually paying more in interest. And you're also going to incur bank fees. They're going to hit you with a late pay fee. So it's definitely something you want to make sure you're paying on time or even before your scheduled payment to avoid any additional interest late payments, and also to make sure that we keep that good score intact. That's 35% of your history. That can drop significantly. One late pay and your score can go down 20, 30 points, depending on what the rest of your credit looks like. So you can take a big hit, maybe even 50 points, depending on what your score actually looks like and where it's at today. So make sure you're paying those payments on time, but 30 days is when it's really considered late when it comes to your FICO. The next piece of the pie, the biggest piece of the pie, is 30% of amounts owed. 30%. So the rule here is anything that's over 30% utilization can start bringing your score down quite a bit. I've seen people's scores jump up 40 points overnight just because they paid an additional $10 and got that balance under the 30% utilization. So what we're talking about here is, let's say you have a credit card with a limit of 1,000. You'd want to make sure that you stayed at or under $300. If you're carrying a balance every month and you can't pay it off completely, you want to make sure that you don't go over 30% utilization. So in that case, it'll start negatively impacting your credit if you're over 30%. So $310 versus $299, making that additional few dollars in your payment could potentially boost your score significantly. So make sure you're doing the math, and if you have to carry a balance, you're only utilizing 30% of all of your available limits. So again, if your available limit is 1,000, the example would be to keep it under $300 if you needed to keep a balance on that card. The other portion, 15% of your credit, is going to be the length of history. And we'll get into some myths around credit history and how long you want to have these accounts, or what happens when you close a credit card. But what I will say when we get into the myths is, here's an example. Let's say you had a credit card that was open for 15, 20 years. That would be a card that you'd probably want to keep open versus maybe one that you just recently got maybe in the last year or two, because we want to see that you're able to maintain good credit history and a good relationship with the lender for a long period of time. So 15% of your credit history is how long you've had those accounts open. So I always advise, if you have to close a card, don't make it the one that you've had the longest history standing with. And then 10% is new credit. So we look at this because we want to make sure that you're not taking out too much credit too soon. That can be considered a flag. So if you've opened up 5 accounts in the last 6 months, that could start to significantly bring your score down. But that's only 10% of your score, not as much of an impact as if you were to have missed a payment. So keep those new accounts to a minimum. The standard is usually 2 new accounts every 2 years. And I know it doesn't sound like a lot, but if we're really responsible with our credit, we really shouldn't have a need to borrow more than, once or twice a year. I would say maybe something big like a home purchase or auto, but we really shouldn't have a need to open up multiple credit cards within 1 year. So try to keep that at 2 new accounts every 24 months. And we also have the 10% of credit mix. So this tells lenders what type of credit you've been responsible with. So if you have an installment loan, which is where you have set payments every single month, and once that term is up, it's paid off, it's completely done, that tells us that you can stick to an agreement with the lender that you're responsible for paying those set payments on time, and that you can pay off an installment loan or debt and your obligations. So that would be something like an auto loan. That is considered an installment loan. And then we're also looking for those revolving lines. We want to see that you have a good mix, that you're responsible with credit cards, things that you have maybe higher limits on, that you're not, overextending yourself, and that you're staying within that 30%. So we want to see that you're responsible with revolving credit that's not secured, and then also that secured installment debt. So it's important to have a good mix on your credit. Especially if you're going to buy a home, they do like to see at least 3 types of credit on your credit report in order to qualify. So it's good to have that auto, credit card, just that good mix. But your mortgage banker, if you are ready to buy a home, will let you know what they need to see on your credit. Okay, so those are all the percentages that make up the FICO score and what impacts you the most. Again, we don't have an exact calculation. I wish I could tell you exactly what your score would be tomorrow if you made one change, but just note that if you focus on these different areas, what would potentially boost your score the fastest? Okay, so we have that example that I gave earlier about utilization. So Angela has a credit card, but her limit, because she has great credit, and maybe makes a little more income, her limit is $10,000. Her credit card balance is $5,000. And in this scenario, Diego has a limit of $1,000 and a credit card balance of $800. Angela, even though she owes more, is actually in a better position when it comes to what's reported on the credit bureaus because she has less utilization. Diego is at 80% utilization and Angela's only at 50%. And Angela may be slightly over that 30% utilization that we're looking for. We'd probably prefer her to be around 3,000 if she's going to carry a balance. But in this case, even though she owes more, her credit score is probably going to be much better because her utilization percentage is down. Versus Diego, who's almost at his limit, almost maxed out. Okay, we're going to talk about how to build credit. We talked a little bit about how to maintain that good score, what can impact our score, but where do we even start? If we don't even have credit today, and we need credit to qualify for credit and to build that story, where do we start? Okay, well, we're going to start making some goals and seeing what we can afford, and what really is important to us and why we need to build credit in the first place. There are things out there that can help us establish. There's starter cards out there with lower limits. I've seen a lot of cards that offer $300 limits just to get you started, and over time those will increase. You'd want to do your research. Starter credit cards, what you'd want to look up, that might be helpful. There's also secured credit cards. So some lenders offer a secured credit card. This means that you provide the initial deposit and the funds, and you're basically borrowing from yourself. That's the easiest way that I can explain this. And you might ask, why would I ask for credit if I can just come up with the money myself? And the reason is you don't have that credit history established. So a lender may not give you a credit card. You may not even qualify for a starter card if we don't know enough about you, or maybe your job history isn't there. So you would get a secured credit card where you're securing your own credit card with your own funds that you've saved. And then you would be making a payment to yourself. So you are still going into a credit contract that would be reported to all three credit bureaus, but you're reporting the payment that you're basically making back to yourself. But this way, it would help you start establishing some good payment history. Same thing with secured loans. You can do a secured loan, and that would be where you borrow one lump sum back from yourself. So a credit card, again, is revolving. But if you're looking at a secured loan, you're signing up for a term, you're signing an agreement with a lender saying that you're going to pay yourself back, and that you're going to pay that secured loan off completely. But again, you're putting up your own money for a deposit, paying yourself back, getting those funds back right away. So so you still have access to it, but you're going to start paying on that agreement, and then it'll be reported to all three credit bureaus. You can also get a cosigner. So if you do have somebody in your household or a family member that's willing to cosign for you, that might also help you build credit. What I will say on the other side of that is, once you have great credit established, be very, very careful of being someone else's cosigner. Depending on where you're at in your credit journey, if you're just getting started, you want to build credit, somebody might be willing to be a cosigner for you. But if somebody does not have a great credit history established and they're in need of a cosigner to qualify for any future loans, be very, very careful, because it might be highly unlikely that they'll help you pay back that loan. And once you're a cosigner on someone else's loan, even though they're responsible and they say they're going to make the payment, it's their loan, you're using your credit in order to co-sign for that person, just like they would be for you. And so if that person misses a payment, it's actually going to report negatively on your credit. So just make sure you're careful with being a co-signer yourself. But if you're in a place where you're just getting started, this is a great option if someone in your family is willing to do that. But know that if you don't make that payment, you're also negatively impacting that person who was willing to co-sign for you. So that might be an option. It's not the most popular one, but it is an option out there. And the other one is becoming an authorized user. This is different than being a co-signer. So my daughter turned 18 not too long ago, a couple years ago, And I added her to one of my credit cards that I've had for over 20 years. She instantly established credit. I just had to call that credit card company, give them her social, and she was added as an authorized user. So she instantly had something reporting on her credit when she turned 18. So if you have somebody that would allow you to go onto one of their existing credit accounts as an authorized user, that is also a quick way to start building and establishing credit. Okay, now we're going to get into some myths around credit that we touched on a little bit throughout the presentation. This is the one that I was talking about earlier. Closing a credit card will hurt my score. Not necessarily. If it's a credit card you just took out 6 months ago, you have 5 other credit accounts that you've had for an extremely long time, you don't carry high balances, you don't carry any balances at all, closing a card that you just took out recently is not going to be detrimental to your score. Where this could bring your score down is in that example that I used earlier, is if you have 5 cards open on your credit report and you want to close one, I highly recommend keeping the one that you've had the longest on there. Because if you close that one out, it could significantly bring your score down because now you've lost that credit history and length of time that you've had that account established. If you need to close accounts, or a lender is asking that you close an account, they'll direct you on what to do. If you're going to apply for something and you think, I wonder if I close this card, it'll help my chances of qualifying for this loan, I would recommend don't do anything until that lender advises you to do so, because in some cases it will bring your score down, and it could prevent you from qualifying. If a lender requires you to close an account in order to qualify for a loan, they will let you know. So if you're closing it out because you want to qualify for something, wait until you get that direction from your lender. But if you close accounts, it doesn't necessarily mean that it is going to have a negative impact. It just depends on everyone's scenario. It's a case by case. Okay. So I basically answered this question, but in this scenario, we'll give a more specific scenario. We have Sarah and we have Katie. Sarah had 3 maxed out credit cards, paid off her first card, and decided to close it to remove the temptation. And then 2 of her cards remain maxed out. So in this case, that's going to have a negative impact on Sarah. And that's also because she just lowered her available limits and her utilization is now extremely high. So if she would have kept that third paid off card open, it would have actually lowered her utilization, and showed that she wasn't maxed out on all 3 lines. So in this case, it would have been really beneficial for her to have kept that paid off card open in order to help her increase that score. And then you have Katie, who's opened 5 accounts. All accounts are out of 0, and she closes her newest account to avoid the annual fee. And there's little to no impact because she's not carrying a lot of credit balances and she's been responsible. So those are just 2 examples of how one could negatively impact and one maybe not so much. The second myth is checking my credit will hurt my score. I also touched on this earlier when we talked about being responsible, making sure that you're keeping up on any errors, identity theft. If you have one of those monitoring apps or you're checking your own score, this will not impact your score. This is not considered an inquiry and it will not hurt your score. And I do recommend, again, that you do have something in place, whether it's with your bank or one of those third-party apps, that you are making sure that you're maintaining and checking quite often, since we all have access to that pretty easily these days. But if you do pull it up, it's not going to impact your score. What will impact your score is if you go to a lender and you apply for a loan, that is what's considered a hard inquiry, and that will show up on your credit. One inquiry is not going to significantly drop your credit. It's when we start seeing multiple inquiries. What is the need to establish this much credit in a short period of time? Those can be considered red flags to lenders. So applying for 5 different credit cards within a 6 months time frame, maybe we're looking at, maybe we've extended too much credit too soon, too quickly, in a short period of time. So we want to keep those credit inquiries to a minimum, usually, 1 to 2 per year, 1 to 2 per every 24 months. 24 months is how long those inquiries actually stay on your credit report. So just know that a hard inquiry will stay on your credit report for 24 months. But checking your own score is not considered a hard inquiry. So soft inquiries are no impact to your credit score. So you might hear a lender say, well, this isn't a hard inquiry, it's a soft inquiry. That might be something where you go to open a checking account, maybe a new savings account, and that lender needs to do a soft pull on your credit. Just to kind of know our customer, know our client. They may be required to do a soft inquiry. So you might hear that, and that will not have an impact to your credit score. And again, I already explained what this was. Hard inquiries can impact your score, and that's really when you're just applying for credit in general. Tips for using credit cards wisely. I've heard a lot, oh, credit cards are bad. I want to stay away from those credit cards. And there are ways that credit cards can be very helpful, useful, as long as we're responsible with them and we understand the whole purpose for having one. Have money in your savings. There's a course that we do that we've done in the past, and if you've had the opportunity to take it or attend it, great. And if you can later at other presentations you see it pop up, I strongly advise. But it's budgeting. We talk about paying yourself first. So if you're going to have that credit card, make sure you treat yourself personally like a bill. Start putting that money in that savings account so that you can make sure and ensure that you can pay your payments on time if anything were to happen. So always have money in savings, and that way you can also establish if maybe using that credit card is the best in that scenario. If there's an emergency, would it be more wise to dip into your savings, or do we need to use that credit card in that scenario? So try to always pay yourself first, put a little bit of money in savings every single month. And then that way you're establishing a good backup plan in addition to using a credit card. Okay. And when you're looking at that credit card usage, really look at it as if you can pay this back in 1 month. Really think about that. If I use this card today, if I don't have the funds today, am I going to have the funds next month to pay this off? We look at, my teenage daughter. We're trying to teach her the right way to use a credit card. Concert tickets are not the reason to buy or to use your credit card, unless you're going to get points and you're going to turn around and you're going to pay it off the very next day. So in this scenario, when we're talking about using it wisely, if you have the funds in that savings or your checking account to be able to pay that credit card off within 30 days, then great. Maybe you do use it for the concert tickets. Maybe there's rewards points or cash back that you want to take advantage of. That's a great strategy. But if you're going to purchase those concert tickets or something maybe that you don't absolutely need right now in the moment, if you're going to carry it longer than a month, using your credit card is probably not the best route to go. Maybe you look at having that savings account established and built up because now you're going to be paying interest for who knows how long on those concert tickets, and they can end up being $300 for a $150 concert ticket. So it can be a very expensive way to make those purchases if you don't intend on paying it off right away. And again, keeping those balances below 1/3 of your maximum available limit, so 30% in that scenario earlier that I gave. If you have a $10,000 credit card limit, then you'd want to make sure that you don't use more than $3,000 at all times, or that you're not carrying that balance over. So maybe you used all $10,000 because you were going to book a trip to Hawaii, but you had that money sitting in your savings. So once that credit card transaction went through, you turned around and made that full payment within that 30 days. So you didn't carry that balance. But if you are going to carry a balance and you had an emergency in that scenario, you'd want to make sure that you didn't exceed $3,000 of that $10,000 limit in order to still maintain that good score. And then paying that off entirely every month so that you can avoid that interest in those fees. It can be very, very expensive. And checking your credit report and score for accuracy. So again, if you are using those credit cards, making sure that everything is being reported accurately, your balances, your payment history, and that we're maintaining that good score depending on our usage. So credit cards can be good. We all need them for emergencies. Things happen. It's good to have. They're also really great for cash back. I myself and a lot of our members like to put all of their utility bills on their credit cards every single month. It's a bill that we were going to pay either way. And then next thing you know, we're getting $100 cash back every single month. So we're getting paid to actually use that credit card. But again, we're paying that balance off every month. So we're making money off of those credit card transactions. So you can use credit cards wisely. There can be a strategy around credit cards. Just be very responsible. Okay, and we do have partners at GreenPath, and they help with credit counseling and guidance. So if you ever want more in-depth coaching or assistance, you can contact one of our bankers, or you can even look up GreenPath online, and they're a really, really good resource for more helpful advice and guidance around financial goals. Okay, one of my favorite parts of the evening, because you all shared your valuable time with us and we have such a great partnership with Pima, anyone who has attended this session and this presentation is actually eligible for our $100 offer. We have a nice QR code there, but you can also connect with any of our bankers in any of our branches. But you actually get $100 when you open up a checking account with OneAZ Credit Union for being a partner of Pima Community College, whether you're a student or a faculty member. You can absolutely take advantage of this offer through this partnership. So feel free to reach out if you have any questions. But I think we're gonna hand it over now. I think it's Samara for us to do our activity.
Yes, thank you so much, Vanessa. Thank you for this great presentation on credit scores. We truly always appreciate OneAZ Credit Union's time and expertise, so thank you. All right, well, everyone, before we do start answering your questions, we are going to have a fun Menti activity. But if you do still have questions, the chat is still available for you to add those. But yeah, let's get started with the Menti activity. Let me share my screen. Okay, so hopefully you are all eager to participate. If you are, please look up menti.com, or you can even scan the QR code. If you do go to menti.com, please enter the code 94013730. And the code is 94013730. Okay, I'll give you all a moment. All right. So the way that it works is that I'm going to give you a statement and you will decide if the statement is myth or fact. Hopefully you don't let Vanessa down and you can remember everything that she taught us today. So let's get started. And then Vanessa, please, you're more than welcome to jump in if you have any advice or input that you would like to share. Oh, yay. We have so many people playing. That's good. And I added a leadership board, so hopefully that keeps you motivated to see who can answer the most questions correctly. Oh, I just skipped one. I'm so sorry. Give me 1 second. Okay. Your credit does not play a big role in determining the terms of a loan. Is that a myth or a fact? Okay. Let's see the results. Okay. That's a myth.
Yes, I'll just touch on that. Just a quick reminder, we talked earlier about the two scenarios where if you had a higher score versus a lower score, you could end up paying more in interest. So it does impact the terms of the loan when it comes to how much interest you're paying and what that payment might be.
Thank you. Okay, next question. You should check your credit report from each of the 3 main credit bureaus at least once per year. Is that a myth or a fact? Hopefully everyone gets this one right. Okay, that's a fact.
But that one we talked about a lot. So I'm glad everybody did well with that one.
Yes. Okay, next question. closing a credit card will hurt your credit score. Is that a myth or a fact? Ooh, so that's actually a fact. Vanessa, would you like to add to this?
Yeah, I feel like this one might be that trick question. Because we said closing out a credit card will hurt your credit score, and we talked about the scenario. So I think we might have, I didn't catch this one, but this one I think it could go either way, because if you've had that card for a long time and you close it out, it could impact you. If you paid off a card and you closed it and now you have high utilization, it could negatively impact you. So if you recently opened that card and you paid it off, it wouldn't. So I think everyone's kind of right in this scenario. I guess I could have added more
It
details,
just
but
depends on the
good job.
situation
Depending on
that
where
they're
your
in.
mind was. Yeah, it doesn't always hurt your credit score. It just depends on the scenario.
Right, thank you for clarifying that. Okay, so far, Annie, you're doing great. Keep it up. We still have plenty of questions, so let's keep playing. The only way to improve your credit score is to pay off your entire balance every month. Is that a myth or a fact? It's a myth. Vanessa, would you like to add to that?
Yes, this one is a myth. It definitely helps if we can pay off our credit cards every single month, but there are so many other things that you can do. I mean, we talked about the utilization. So if we can just make a significant payment to one card and get below 30% utilization, maybe we don't pay it off every month, that can significantly help us. If we catch an error on our credit report that we're able to dispute, maybe a payment that wasn't reported correctly, that can help our score. Keeping our inquiries to a minimum can also help our score, and just making those payments on time. So a lot of things that we can do in order to help our score improve every month.
Great, thank you. The next question. If you pay off your entire credit card balance in full every month, you will hurt your score. You must carry some balance from month to month. Is this a myth or a fact? Hey, myth. Everybody got that one right.
Yeah, I don't need to add my 2 cents. Everyone's
No, they
on
all
it.
got an
Yep.
A+ on that. Okay, the next question. It's possible to have a high credit score even if you don't earn that much income. Is this a myth or a fact? Yes, it's a fact.
Yeah, I think we've all heard that term. The more money you make, the more money you spend. Doesn't necessarily mean that you're a good saver or that you've been responsible with your credit.
Thank you. So let's see who's on the run. Okay, Croc, you're doing great. Beyonce, I see you. Okay, let's keep going. Your credit report includes personal information, credit accounts, collection accounts, public records, and inquiries. Is this a myth or is it a fact? It is a fact.
Yes, this is one of those things that we covered earlier in the presentation. Some of those items that might come up on your credit. The ones that are not on your credit are the checking accounts, the savings accounts, things that you might have with your institution like day to day.
Thank you. We're almost there. Let's look at question 8. You guys are doing great. Thank you for participating. You can eliminate negative parts of your credit score by closing accounts that are overdue. Is this a myth or a fact? This is a myth.
Correct. So if you have that negative payment history or you weren't able to make or pay off the balance, they're still going to report it to the credit bureaus. That's kind of like how we said earlier, the checking account doesn't report to your credit day to day. But the minute that you owe the bank that money or you had a charge off checking account, it's going to report that those accounts can actually stay on your credit for up to 7 years, any negative account history.
Wow. So we have to make good choices every day, huh? All right, next question. Using your debit card responsibly will increase your credit score slightly, but less than using a credit card. Is this myth or fact? This is a myth. Vanessa, would you like to add?
Yeah, this is a tricky one. Kind of gave you a hint in the previous answer. But yeah, checking accounts don't report to the credit bureaus. So that debit card is actually not going to report either because that's tied to your checking account. So debit cards do not report to your credit bureaus.
Thank you. Okay. 10th question, and then we have one more after that. It's important to pay the entire credit card balance monthly to avoid interest fees or interest or end fees. Is this a myth or a fact? Fact. It is a fact.
Yes, it's important, but we can't always do it. But just note that if you have to carry the balance, you're going to be paying more in interest and fees.
All right, so let's look at our last question. And this one will be added to the leader board. It's just for us to see how you're feeling about so far today's presentation. What do you think about today's lesson? Do you feel lost? Are you feeling great? We really value your feedback. Awesome, that makes me happy. Okay.
You and me both. That one makes me
Yes.
nervous every time. It's like
I
the
know.
drum roll.
Yes. Okay, so let me stop sharing. Thank you everyone so much for participating in the Menti activity. I hope that it just, made you practice everything that you've learned from today's presentation. Well, let's see. Now, as we usually do during our Money Matters activity, Money Matters events, we offer a handout flyer, which contains great resources for you to review. We also share copies of the slides that we use this evening so that you can share with your loved ones. So if you would like to have access to those resources, Anna is sharing the link right now. Please spread the wealth of knowledge and share with all your family and friends. Again, this was great information. And, thank you, Anna, for sharing those links. Okay, so I think it's time for our Q&A. Please know, that you still have time to ask any questions as we're going through the questions that people have asked so far. So if you do come up with something, just make sure that you're adding those on the chat or messaging Anna, privately if you feel more comfortable. Okay, so let's look at the first question, and then Vanessa, you could please help us answer those.
Yes.
So first, thank you. So the first one is, when is it a good time to refinance a loan?
Oh, okay. It really just depends what loan we're talking about, but I'll give a couple of different scenarios. So right now we keep hearing a lot about mortgage. So when you look at refinancing a mortgage, I hear a lot of things about, 0.5, 0% rule of thumb for savings on a mortgage. But really, anytime that rate drops, start looking at if it's a good time to refinance. Do the comparison of where you're at currently in your loan. If you're almost done paying off that loan, maybe refinancing doesn't make the most sense. We also hear a lot about refinancing on mortgages when you want to take cash out of your home. Maybe you have what we call equity. That might be a good time to refinance. So, but if you're talking about as far as rate goes, like where the most savings is at, I would say really rate shop, do the comparison, and also ask yourself what's important to you. Are you looking to do the long-term savings like we saw in that scenario? Or is this a situation where you need to cut your monthly expenses? If you need to cut your monthly expenses, and I would say any dollar you can save would mean it's a good time to refinance. But if saving money over the life of the loan is important to you, then you'd really want to look at, is that rate difference enough to be able to have that savings and that cost? So again, if you're close to paying off a 30-year mortgage or a mortgage, maybe refinancing isn't going to save you a whole lot. But what we do see with auto loans is a lot of people will refinance in the first 6 months to a year if the rates are better. Because when you do an auto loan, we have what's called front end loaded interest, and that's usually all auto loans. So you're going to be paying most of that interest up front. So if you're towards the end of your auto loan and you refinance to get a better rate, you might actually be paying more money in the long run because you've already paid all that interest up front. So if you're close to paying off your auto, I would say ask yourself again the reasons for wanting to refinance. Do you need a more affordable payment over the next year, even though you only have a year left to pay it off? Or is it the rate that's really important to you? And usually people will refinance for the rate in the first 6 months to a year of having that auto loan. But it really depends on the significance in rates. We know 3 years ago, an auto loan rate was 1.8, and now we're looking at 9%. So just really do your research and look at what your whole reason for wanting to refinance is.
Thank you so much. Second question is, would using annual creditreport.com be a hit on your credit score?
No, that would be, that is not an inquiry. That's just a really good resource that's free to use once a year. They'll give you a detailed credit report once a year when you log in.
Thank you. Could it be problematic if your current employer doesn't show on any reports, even if it was used to apply for a credit card?
Can we get some clarification on that one when we're talking about current employer on credit reports?
Okay, we can let the participant maybe message Anna, and then we'll wait on that, and then we can move forward for now.
Okay.
Is that okay?
Yeah.
So whoever asked that question, please, you can directly message Anna and just provide more information. That way Vanessa can answer your question. Okay, so the next question is, by freezing our credit score, does it stay the same, meaning it will not increase or decrease? And when is freezing your credit score necessary?
We have some people that just have their credit frozen just to get ahead of anything. They're just more comfortable with that. So it's really your personal preference. But what I will say is there are people out there that make a living off of identity theft. That is their full-time job. It is like a business. And I would suggest, me personally, being a victim of identity theft, of just having it frozen. It doesn't hurt anything. It's not going to hurt your score, but it will make it hard for a lender to run your credit or have another inquiry on there that wasn't you. So it's also very easy to unfreeze your credit. They have a lot of apps now where you can just click that little radio button. It says unlock, and it unlocks it instantly. And then you click it back as soon as you're ready to relock it again. So if you're going to apply for an auto loan, you just want to make sure you unlock your credit right before you apply for the loan. Same thing with mortgage, but it does not hurt your credit score. And I would say if you have a credit monitoring service that you're currently using, it doesn't hurt to freeze your credit. I would do it just to take that precaution.
Perfect. Thank you. Okay, next question. I'm trying to build my credit score. I pay off my credit card in full every month. Is it still helping me build credit, or should I leave a very small balance, 2% on it?
Paying it off is not going to hurt your credit. That shows that you're responsible with it. But what we do want to see is that you're actually using it. So if you are using it every month and then you're paying it off, that at least shows us that there's been some type of transaction history. So making that payment on time, you're showing that lender that you've been responsible for making a payment. So definitely keep using it. But no, you don't have to carry a balance in order for it to reflect as good credit.
Thank you. Roughly, how much time should one wait before applying for multiple types of loans?
Yeah, so it depends. If you really need that credit, I've seen some people that want to buy a house, but they really need a new car. But we've always advised them to not make that car purchase right before they're going to buy a home. So everyone's scenario is different. But as soon as they buy that home, now that home is a new credit inquiry, a new account on their credit, that auto loan that they have to get, and then maybe they needed to do some home repair, so they're taking out a credit card. That's not going to hurt you too bad. But when we start to see that you've had like 5 accounts open in the last 6 months, we're going to look at why, what types of accounts those are. The rule of thumb and what stays on your credit is all new inquiries stay on there for 24 months. That is just what stays on that credit report. We can't change that. So anything that you do apply for with the hard inquiry when you're applying for new credit will stay on for 24 months. It's not going to significantly bring your score down if you have 5 inquiries within those 24 months, but to have excellent inquiry history, that 10% that makes up that pie, they say 2 inquiries every 24 months is really ideal. But we know things happen. Maybe you make a lot of life changes at one time. It's not going to mean that it significantly drops you, but just be very, very careful. What we're really looking for is, did you just open up 5 new credit cards? That's a red flag to a lender. We just want to make sure that you're not taking out too much credit too soon, unsecured credit, or living outside of your means. I think Mike and I see this all the time where there's somebody new to credit. Maybe they're 18, 20, 21, or maybe even just later, you're just starting to establish, or you just repaired your credit. We've seen this with people that have filed bankruptcy, things happen, and they get themselves right back into the same situation. So we have, some of the younger that are just learning how to understand their credit, where they go and they buy a brand new lifted truck, and then they want a jet ski, and then they want to finance, what do you call them? ATVs? I don't know. I'm not outdoorsy, but they want all their toys financed. And then next thing you know, they're getting all these pre-approval letters because their credit's outstanding in the mail, and they're accepting every single one of them. And within 12 months time, they have 8 new credit accounts open and their score has significantly dropped. So we want to see that you're living within your means and you're not financing everything just because you can. That's where we get into where we can't afford those minimum payments anymore.
Thank you. Okay, next question. Do you need to have a certain credit score to be a co-signer?
Not necessarily. So we have auto loans, and a lot of lenders will look at what tier you fall in. So we might ask that you do a co-signer to get a better rate or to qualify. You could qualify for a loan with a 620 on an auto. And I'm not saying that's exactly where you need to be, because we've done them lower. But maybe you're co-signing for someone who has a 580, but at 620 you qualify. There really is no set guideline, but it can help in cases where you don't have credit established, or maybe you need the higher credit score in order to get the better rate. That would be where a co-signer could be helpful.
Thank you. How does bankruptcy affect my credit report and credit score?
Bankruptcy is interesting. I think we cover that on another one of our credit presentations. It really depends what type of bankruptcy that you filed, but you're basically wiping that slate clean with that bankruptcy. It is going to stay on there. Some bankruptcies up to 10 years. It maybe doesn't impact your score significantly over that 10-year time frame. As as those years pass, it impacts you less and less. there are some cases where you can do a bankruptcy and then within 60 days you have another credit card. Another lender gives you another credit card. Where it could hurt is if you're trying to buy a home, they usually look at, did you file bankruptcy in the last 3 years when you're doing a home purchase? So they are going to look at that. So if there's been a bankruptcy in the last 3 years, it might make it harder for one of those larger purchases like buying a home. But some lenders might actually give you a credit card within 30 to 60 days. I've also seen people with bankruptcy have better credit scores within a year than somebody who's never filed bankruptcy because they started over and they were responsible with it. But we've also seen people file bankruptcy and then turn around and take out 6 new credit cards and max them all out and end up right back in the same scenario. So it really depends on if we learned our lesson and if we're smartly reestablishing that credit. But yes, it can stay on and it can impact other purchases that you're trying to make. And you're definitely going to get higher interest rates. So if you go to apply for an auto shortly after filing bankruptcy, you're probably going to end up with a much higher interest rate.
Thank you. Next question. How long does information remain on my credit report?
That would be a good payment history, like we saw earlier, is going to be indefinitely. So if you have a credit card that is still open and you've made all your payments on time, that history is going to stay there indefinitely. If you have a negative account that you've paid off, that's going to stay on there for 7 years. That late pay is going to stay there. It doesn't impact your score as much over time. So, 5 years in, it's probably not going to have that significant decrease in points on your FICO. But it will stay on there as part of your history for that full 7 years. Just won't have as much of an impact as the years go on.
Would paying off debts help or hurt my credit score?
Paying off debt always helps. Pay it off. Yep. And it lowers your monthly payments. So if you can, work to pay it off. Some advice that I will give, and we do a credit presentation. We look at paying to make it more affordable if you're paying it off so that you can lower those monthly payments. Start with your smallest account balances. Some people want to jump right in because they hate having that larger account balance looming over their head. But one rule of thumb is to start with a smaller balance. So if you have an account that you owe $300 on and an account that you owe $3,000 on, start with the $300, and that payment that you would have been making towards that $300, now start applying that additional payment and towards that larger balance and start chipping away. That is probably the easiest way to do it. But yes, we always suggest and advise to pay off those balances and also save yourself money and interest that you're paying on those cards.
Thank you. Is there a way to get hard inquiries off of a credit report?
Yes, you would have to dispute them and they would investigate it. So if it was you, the chances of them removing it are probably very slim. But if you do see something that it wasn't you, or you didn't give permission to a lender to run your credit, then absolutely dispute it. You can check with the lender first, or the bank first, or the creditor first, to see if they can help remove that if it was their error. Or you can go through the credit bureaus, TransUnion, Experian, Equifax, to see if you can get that inquiry disputed. One thing I want to mention about inquiries that might be alarming: if you haven't pulled your credit report yet and you recently purchased an auto, you might see 30 inquiries on your credit. So that's one thing I do want to mention. Don't dispute all 30. If you just purchased an auto loan and you went through a dealership, they have a system that they basically, once they get your social and they have a permission to pull, it blasts to all lenders that they use on that system. Those do not count as inquiries individually. So we want you to rate shop. As a consumer, you have every right to rate shop and make sure you're getting the best payment. So that dealer will send that out to make sure that you have the most affordable payment and they're giving you the best deal. But if you're looking within a 2-week time frame, that's not considered 30 multiple credit pulls. They want you to rate shop. They know that. And so it's not actually impacting your FICO. So don't feel the need, if you see that maybe you went to go buy a Honda and they ran you to 30 different lenders, you don't have the need to dispute all of those. They do not impact your credit. Now, if you apply for an auto loan today and then you wait 30 days because you changed your mind and you go back to apply for an auto loan, that will count as 2 separate inquiries. So you do have time to rate shop in a short window without it actually impacting your credit score.
Thank you. Next question. Is it true that having no credit card debt, but you open cards and a good credit score affects how likely you are to get a loan or how much that loan would be?
There's a couple things that go into that question. So again, if you have credit cards open and your score looks great, but you don't have a lot of credit usage or history, they could potentially close those cards out on you. So be careful with that. So if you aren't using them at all and you have a credit card that you've had for a very long time, they could close it out without notice to you. Or they might send you something saying, hey, do one transaction in order to keep this account active. So I do advise to at least use your cards every now and then if you plan to keep them open. Now, if you are carrying balances, how much a lender might lend to you if you do apply for a new loan can actually be impacted because we have what's called DTI. And so if you show that you have multiple payments outstanding, we need to know that you can afford all of those payments that you're taking on. So again, that's the reason why you want to keep those payments down or those balances to a minimum, but still make sure that you're keeping them active because we want to make sure that you can afford new debt when you go to apply for a loan.
Thank you. We have a few more. If an account is closed on my credit report, should I still pay that debt back?
Yes. If they've closed that on you, so banks can actually review your credit. It's in your disclosures. It won't count as an inquiry, but they can review your credit periodically. And let's say you started with a 720 FICO when you first took out that credit card, and now you're at a 580. That credit card company or that lender can actually shut that card down on you, but you've already used the money. So you have to be responsible for the debt that you took on. So if you're not going to give, I don't know, the stereo back. Do we even buy stereos anymore? I'm just thinking like I'm going to Best Buy. But if you made the purchase, you still owe it, right? The bank didn't walk away with those goods. So you still are responsible for anything that you use to make those purchases, any of those funds. So you are responsible for that. If it's a collection account, absolutely try to pay that because what you can do with a lot of collection agencies is you can negotiate. So if you call them, they are a third party. They make a commission, to my knowledge, for gaining those balances or getting those balances paid, but they are willing to negotiate because they do have a benefit for getting any of that that balance back that's paid. So if it's a collection account, work with those collection agencies, try to negotiate that payment. And one thing you can do once it goes to collections is you can ask for it to be completely removed from your credit. So if you can negotiate paying off a certain portion of that balance, or you can come up with all of the funds to pay off that collection account once it's been sent, you could ask them, if I pay this, can you completely remove this from my credit? Once you pay that collection agency and they've agreed to that, it'll be removed like it never happened. So that is one helpful tip. Try to negotiate with those collection agencies. But if it's a credit card company that has not yet sent you to collections, and you might think, why did they just close my card if I've never been late with this credit card company? It's because they pulled your credit and maybe they saw that you were at risk now because you've been paying delinquent to other lenders. And so they didn't want to end up on that list. And so they closed your card down, but you're not yet in collections. You still have to make the payment now that's owed to the balance that you've already used.
Thank you. We have two more questions. I was under the impression that using your credit card regularly, but not too much, and paying off your balance in full every month is best for building credit. But I've noticed that my credit score goes up months where I don't use my credit card at all. Why is this?
Look at your statement cycle. So even though you might be paying it off, if you're not paying it off before they report it to the credit bureaus, it's going to reflect on to your FICO. So look at your statement cycle. So you might have a payment due on the 1st, but they actually report whatever balance is outstanding a few days later. So just because your payment's due on the 1st doesn't mean that that gets reported to the credit bureau that day. Usually there's a few business day lag. So if it's due on the 1st, they might be reporting the balance on the 5th. So you'd want to check with your credit card company to see when your statement cycle ends, because they might be paying off the balance that you have that day, that snapshot of that day, and not necessarily what you had on the day that it was due.
Okay, so we have time for one more question. The last question is, Which would be better to pay for higher education between these two options, the home equity line of credit or private student loans, assuming all federal options have been exhausted?
This one might be a team effort. So for higher education, this might be a team effort. I don't know if you ladies want to take what options they have first, and then I can go into, if those are exhausted, what we can do on our end.
Sure, absolutely. So if you have any student loans, we highly recommend, depending on who is holding your student loans, whether they're private student loans or they're loans that are serviced by the Department of Education, we have some resources that we would like to share. For example, Pima partnered with Student Connections which is an organization that provides one-on-one assistance with student loan repayment option at no cost to students. So I'm going to go ahead and share that through our chat here in a moment, but it does assist students with student debt relief, and this is just particularly with student loans. So we do have some resources that we could share, and then as far as the ATLOC, the home equity line of credit, Vanessa, do you want to take that first?
Yeah, so if you don't have any available resources through your lovely team, you definitely want to sit with a banker at your own financial institution or visit one of ours. It's completely up to you. But if you have equity in your home, that is a very popular choice for when people want to take out larger loans at a lower rate. It's a secured loan, so it's tied to your home. So they're basically saying, if you don't pay this loan back, we could, forcibly use your home as collateral to pay that debt. So the rates typically tend to be lower than taking out an unsecured loan to pay your student loans or to pay for your student costs. So a home equity is a great way to go if you've exhausted all their options, if you want a much lower rate. And in some cases, because it's a home equity line of credit, you could also possibly get a tax deduction through the interest that's tied to your home. So definitely sit with a banker though and look at all of your options even if you have the equity available, because the equity would need to be available in order for you to use the home equity line of credit. And I did see in the chat that I didn't answer that question correctly. I did see that pop up. So I think the question was, if we didn't carry the balances, or if there was never a balance, even the card wasn't ever used or swiped, so there shouldn't have been anything carrying over. What that also might be is the fluctuation in time of accounts, how long you've had those accounts open. So I'm going back to the question that we had before. I saw that chat that I didn't answer correctly, or they needed clarification. So again, there's really no set calculation for what impacts the credit, but it could have been that you hit a certain milestone in length of time that you've had one of those accounts open, so you saw a jump in your score.
Thank you, Vanessa. Thanks for sharing that. And thank you both, Simara and Vanessa, for your valuable input. And now, yes, what is next? So we will announce the social media winners at this time. But first, we'd just like to thank everyone who followed us on our social media accounts for Pima's first year experience programs and the Office of Financial Aid and Scholarships. Those who did were entered into a drawing, and the following people are this evening's winners. So the FYE winner is Suhail Gastelum. Congratulations. And the Office of Financial Aid and Scholarships winner is Mariana Mariscal. So congratulations to you both. You each won a prize bundle, which will include a mix of the prize options displayed on the screen from Pima Community College's Office of Financial Aid and Scholarships first year experience and OneAZ Credit Union. We will send your prize packages soon to the mailing address provided in your Pima student profile. Please allow a few weeks for us to get things packaged and delivered to you all in the mail. If you have not heard from us by next month, please follow up with us and we can troubleshoot and track down your prize. And thank you to everyone for attending the second and final Money Matters session of the semester. We hope that you found great value in the information that was shared today and that you enjoyed this session. We do plan to return next fall, so be sure to check out the events page on the Office of Financial Aid and Scholarships website. If you attended all 2 Spring Money Matters sessions, you will be entered into a drawing for a $300 award tuition award that can be applied to the summer of 2024 tuition or fall of 2024, which is a great opportunity. So an email will be sent to the winner 2 weeks after today's event. And then please take a moment to complete the survey to let us know how we did. Your feedback is greatly appreciated. Completing the survey also earns you a certificate of completion, which will be emailed to you in the next few weeks as well. And our time together here has come to an end this evening, but if you would like to follow up and contact us, our information is shared on the screen. This also includes a link to OneAZ Credit Union. And a huge thanks to our partners from OneAZ Credit Union, PCC First Year Experience, and the Office of Financial Aid and Scholarships. Have a wonderful evening, everyone, and thank you for your participation. See you next fall.
Thank you, everybody.